Welcome investors to Joe's Investment Express. I want to share with you today probably the most important breakthrough that I ever made in technical analysis. An epiphany that I had that really changed everything. My trading got so much better after I realized this. After this epiphany. What is an epiphany? An epiphany is a sudden, momentous revelation that changes everything. Now, I've made some real breakthroughs over the years. One is finally figuring out to use stop losses and how to use them. Another one is using progressive exposure. Another one is selling half or a third instead of the whole thing. I could go on and list a bunch of those. But my trading changed dramatically when I figured out to look at the charts in terms of supply and demand. And I didn't come to this breakthrough on my own. When I started following Mark Minervini, I kept hearing him talking about supply and demand. And I was like, what are you talking about? And finally I got it. So, for many years previous to that, and even to this day, everyone talks about support and resistance, And you draw these lines here and there, and there's support here and resistance there. And fundamentally, it seemed kind of like smoke and mirrors, I suppose. So let's look at supply and demand. First of all, what is the stock market? It's an auction. And when demand exceeds supply, a stock's price goes up. When supply exceeds demand, a stock's price goes down. So when we're looking at charts, what we need to do is look at where is there supply and where is there demand. This is the chart for Dollar Tree DLTR, which is doing great this year, by the way. And I've helped us out here by marking zones of supply and demand in green. So let's just talk through this chart. I really hope I can articulate this. It's a little bit ethereal or intangible, but I will try to make it concrete. Okay, so let's start over here. This is the 1-year chart. And as you know, the market was really weak this summer for most NASDAQ stocks. And so the price here started at 117 and it started moving down and it gapped down. Obviously, there was much more supply than demand here. Then it started consolidating and weak short-term holders started shaking out. It made this flat base, then it made a little handle, and then it broke out. So the question is, do you buy the breakout? The answer is no, you don't. Why? Because there's tons of potential supply over here. You look to the left and see if there are any shares that might come on the market. All of this price action here, especially these weeks of tight action, these are all shares that potentially could come on the market when it comes back to that price. These guys are underwater and they're sitting on a loss, and this action has been very calm and tight. So most of them are probably still holding their shares, and when it comes up close to break even, they're going to start selling off. And so we don't buy the breakout there. Okay, so the stock gaps down again, puts in some wild action, gaps up, and then we ask ourselves, should we buy the stock right here? Well, again, no. If we look to the left, there is tons of potential supply on here. So we know that the stock's either going to pull back, worst case scenario, or at minimum, it's almost certainly going to slide sideways. And definitely, in hindsight, what does it do? It slides sideways. And then it clears all of this potential supply again. Now, this is a better buy point. Why? Because it's above all of this supply here, and some of this supply got retested and has already come to market. So now we can, with some certainty, know that there's going to be demand for these shares. So we could consider making a buy here, but we know, looking to the left, that there's still this big consolidation zone. There's still probably some supply that's going to come to market here. So we know then when it gets up here, in this case it was like 113, we know that the stock's going to have trouble pushing through this. So if we're swing trading, we know to sell right here. If we're long-term holding, we know there's almost certainly going to be a pullback here, and to just be patient and ride through it, or to buy more. And in reality, that's exactly what happened. It came into this potential supply, and it tried a couple times to break through, failed, pulled back. It had this wicked, wide-ranging red candle, and then it made, this is not a great-looking handle, but we can call this a handle. Incidentally, if you have a big, wide-ranging red candle day, and then it immediately starts going up again, that's a pretty safe spot to get in, because most of the shoe clerks, so to speak, got cleaned out on that previous day. All right, so then probably on earnings, we have a huge gap up here. This is obviously signaling that there's a high demand for the stock. And we look to the left, there's no supply. There are no potential shares. There's nobody holding the shares at a loss here. And so we know that there's no supply waiting to come to market. So this then is really a pretty safe place to buy, and the volume is really strong. Now you may be asking, should we look at the 5 or 10 or 20-year chart to look for supply on those charts? And in my opinion, the answer is no. Anything that's over a year old, in terms of supply, those guys are either multi-year holders or they've already sold their shares. So really, when you're looking at potential supply coming to market, I only look at the 1-year chart. Okay, so we certainly could have bought this gap up here, and so the stock is in high demand, and then it runs up to 150, and it prints a spinning top doji. That's a signal of indecision. In an uptrend, that signals it's often going to roll over. Also, this breakout is about 25%. At 25%, most stocks pause unless it's truly, a groundbreaking disruptor of some sort. So then we have a consolidation zone, and also 150. This is a round number where this is an area that investors like to sell, right? Maybe they bought it at 100 and they say, well, when it hits to 150, I'm going to sell. So now it consolidates and it rolls over here, and then it's no secret, if there's supply here coming to market, then when it tries again, there's probably going to be more supply. So then we had kind of false breakouts here. This would be a very short base. And in a very short base, honestly, you really don't want to buy those. And if you do, you want to wait to the end of the day and make sure that the breakout is going to, it's for real. And in this case, it's not. Then it comes down, gaps down. Now here you have a huge long day. What is it called? Long candle day, white candle, bullish engulfing candle. This is a signal, if you know your Japanese candlesticks, that there is demand for this stock at this level. So you could consider buying some here, but you know that there's all of this supply that's going to give this stock trouble. So you could buy like a quarter here, maybe you buy another quarter here, but you know it's going to have trouble getting through this. So if you're buying down here, you know you got to be patient. You know it's not going to just take off. And sure enough, it works its way up the right side here, hits this same supply coming onto market. There must be some institutions up here selling off. And then it works its way over to the right side, tries to break out a few times, and you wait until near the end of the day. Now, this is in a hard penny environment. In an easy dollar environment, when breakouts are just working every time, then you can buy as soon as it crosses this line. But in the hard penny environment right now, you want to wait and make sure it's going to close with strength. So finally, it does close with strength. Now there's a teeny tiny bit of supply over here, but really that's 2 days, and That's just not a lot of supply. So you just don't worry about that. You buy it here knowing that there's now demand in the stock. It pulls back a little bit, which is just a natural reaction. You don't worry about that. And then it puts together this really nice trend channel, makes this high tight base, and then it breaks out again and it closes at the top of its range of this candle. That's a signal that this stock is still in demand and that the demand is outpacing supply, and it's going to continue going up. So you buy a little bit more right there. All right, well, so in conclusion, instead of just saying, well, there might be support here and resistance here, I think I'm going to buy it because the fundamentals look good, etc. Look at areas of supply on the chart and look at areas of demand and think about, like I said, where is the supply potentially going to come onto market? When is this stock showing demand? Hope that was helpful for you. That was really hard to articulate. Maybe I could do that with another chart sometime. That like I said, was the biggest breakthrough I've ever made. It's really elemental and kind of simple, but I've done so much better with my technical analysis trading since I figured that out. Let me know your comments on that, and if you've had any breakthroughs of your own that you'd like to share. Okay, take care, everybody.